What if I told you that the stock market is not what most people think it is? That it's not just numbers on a screen, not just charts going up and down, not even really about money. What if the stock market is actually a story? A centuries-long experiment in human behavior, belief, fear, greed, trust, and time. Here's the mystery. How did something so powerful, something that controls retirements, governments, wars, innovation, and even your daily cost of living become so poorly understood by the very people whose lives depend on it? Most beginners are taught what the stock market does. Buy low, sell high. Invest for the long term. The market always goes up, but almost no one teaches why it exists, how it evolved, or what really breaks it when it collapses. And here's the unsettling part. Every major stock market disaster in history followed the same pattern, and almost everyone believed this time is different. By the end of this video, I understand why the stock market was created in the first place, how it grew from a small trading experiment into a global power system, why it periodically breaks violently, why most fixes fail, and how those same patterns are repeating right now. But to understand where the stock market is going, we have to go back to where it began. And that story starts long before computers, charts, or even modern money existed. Setting the stage, a world before stocks. Imagine a world without stocks. No retirement accounts, no index funds, no Wall Street, no concept of investing. For most of human history, wealth was simple. You owned land, you owned animals, you owned tools, or you owned nothing at all. Money existed, but it didn't grow. It just moved. If you wanted more wealth, you worked harder, conquered land, or married into it. There was no system that allowed ordinary people to pool money, share risk, or profit from businesses they didn't personally run. And that limitation was a massive problem, because by the late Middle Ages, something had changed. The problem that created the stock market Europe was expanding. Ships were sailing farther. Trade routes stretched across oceans. Empires wanted spices, silk, gold, and power, but exploration was brutally expensive and dangerous. One ship could cost years of labor, massive upfront capital, and still sink without ever returning. If a merchant funded a voyage alone and it failed, they were ruined. So here was the dilemma. How do you fund massive high-risk ventures without destroying the people who attempted them? Kings tried taxation. Merchants tried partnerships, but the risks were still concentrated and catastrophic. Then someone had a radical idea. What if we split ownership? Not just profits, not just losses, but ownership itself. That single idea would change the world forever. Origins, the birth of shares in the early 1600s. The Dutch were facing the same problem every empire faced. They wanted dominance in global trade, especially spices, but the cost of sending fleets to Asia was enormous. So in 1602, the Dutch government approved something revolutionary. The Dutch East India Company, often considered the world's first true publicly traded company. Here's what made it different. Instead of one person owning the company, ownership was divided into pieces. Those pieces were called shares. Anyone with enough money could buy a share. In return, they owned a fraction of the company's profits and risks. This did three critical things. One, it spread risk across many investors. Two, it raised massive capital quickly. Three, it separated ownership from management for the first time in history. You didn't need to sail the ship to profit from the voyage. And just like that, the stock market was born. The first stock market wasn't about investing. Here's something beginners rarely hear. The early stock market wasn't about long-term investing. It was about liquidity. If you bought shares in the Dutch East India Company, you didn't want to wait 10 years to get paid. You wanted the option to sell your ownership to someone else. So informal gatherings formed, coffee houses, public squares, port cities. People met to trade ownership. Eventually, those gatherings became organized. Rules were created. Prices were posted. Disputes were settled. And slowly, a new institution emerged. The stock exchange, the rise. When speculation takes over at first, everything worked beautifully. trade expanded. Wealth grew. Innovation accelerated. But something unexpected happened. People stopped buying shares because they believed in the business. They started buying shares because they believed someone else would pay more later. This shift from ownership to speculation changed everything. The first bubble. Tulip mania in the 1630s. The Netherlands experienced something historians still debate. Tulip bulbs, yes, flowers, became speculative assets. Prices soared. Rare bulbs traded for the price of houses. People borrowed money to buy plants they never intended to grow. Why? Because prices kept going up. Sound familiar? The logic was simple and deadly. If I don't buy now, I'll never afford it later. Eventually, prices collapsed. Fortunes vanished. Trust evaporated. The system survived. But people learned nothing, and that pattern would repeat. Again, and again, and again. Cause and effect, why markets rise at its core. The stock market is a belief engine. Prices don't rise because companies are perfect. They rise because enough people believe in future growth. This belief is fueled by economic expansion, technological breakthroughs, cheap money, social optimism when belief grows faster than reality. Bubbles form, and bubbles always feel logical while you're inside them. The illusion of safety, one of the most dangerous ideas beginners absorb, is this. The stock market is safe if you wait long enough. Historically, that has often been true, but often is not the same as always. And waiting only works if you survive the downturn, the system itself remains intact, and your psychology doesn't force bad decisions. History shows that many investors don't fail because markets crash. They fail because they panic at the worst possible moment. But the real breaking point isn't panic. It's leverage. The breaking point when the system snaps. Every major market collapse shares three ingredients. 1. Excessive confidence. 2. Easy credit. 3. Leverage hiding risk. Leverage means borrowing money to invest. It amplifies gains and destroys stability. When prices fall, leveraged investors are forced to sell. Forced selling pushes prices lower. Lower prices trigger more selling. This feedback loop turns corrections into crashes. The crash of 1929, a case study by the 1920s. America believed it had entered a new era. Technology was booming. Cars, radios, electricity. Stocks only went up. People bought shares on margin, borrowing up to 90% of the purchase price. When prices dipped, margin calls began. Forced selling cascaded. Trust collapsed. The market lost nearly 90% of its value, and the fallout wasn't just financial. It was social, political, psychological. The Great Depression followed. Fallout? Why crashes hurt? More than portfolios, market crashes don't just destroy wealth, they destroy jobs, homes, families, faith in institutions. People stop trusting banks. They stop trusting governments. They stop trusting the future. And when trust disappears, extreme ideas take its place. History shows that financial collapse often precedes political extremism, social unrest, war. The stock market isn't just an economic system. It's a stability system. When it breaks, everything feels unstable. Failed fixes, why regulation isn't a cure after every crash. Leaders promise this will never happen again. They add rules. They regulate leverage. They create safeguards. And for a while, it works. But markets adapt faster than laws. Risk doesn't disappear. It moves. It hides. It disguises itself as innovation. Derivatives, securitization, high-frequency trading, shadow banking. Every fix creates a new vulnerability. And eventually, the cycle repeats. Modern parallels, same story. New technology, today's market looks different. Algorithms trade in milliseconds. Apps gamify investing. Social media moves prices, but the core forces haven't changed. Belief still drives prices. Leverage still amplifies risk. Fear still spreads faster than logic. The names change. The tools change. The psychology doesn't. And beginners entering the market today are stepping into a story that has been unfolding for over 400 years. Transition to what this means for you. So here's the real question. If the stock market is this powerful, this dangerous, and this misunderstood, how should a beginner approach it? Not with hype, and not with fear, but with understanding. In the next part of this story, we'll break down what stocks actually represent, how long-term investing really works, why patience beats intelligence, and how to avoid becoming just another repeating statistic, because the market doesn't reward intelligence. It rewards discipline. The stock market was never designed to be simple. It was designed to solve a problem, how to fund massive risk without destroying individuals. And along the way, it became something else entirely. A belief machine, a speculation engine, a psychological stress test. Now here's the trap most beginners fall into. They think learning the stock market means learning charts. But charts don't explain why people panic. They don't explain why bubbles form, and they definitely don't explain why most investors underperform the market itself. To understand that, we need to answer a deceptively simple question. What is a stock, really? Not the definition you memorize. The reality you live with. What a stock actually is ownership without control. When you buy a stock, you are not buying a lottery ticket. You are buying ownership. A share of stock is a legal claim on a company's future profits, its assets, and its survival. But here's the twist. Most shareholders have almost no control. You don't decide strategy. You don't hire executives. You don't choose direction. You are a silent partner, trusting strangers to allocate capital wisely. This separation between ownership and control is powerful and dangerous because it introduces a new problem. How do you know if the people running the company are acting in your best interest? This question has shaped the entire modern financial system. Why companies sell ownership in the first place? Beginners often assume companies sell stock because they're doing well. Sometimes, but more often, companies sell stock because they need money. They want to expand operations, fund research, pay off debt, or survive competition. Selling ownership is expensive. Once you sell a share, you can never take it back cheaply. So companies only do it when they believe the trade-off is worth it. That means every stock you buy exists because someone wanted capital and believed the future gains justified sharing ownership. That doesn't make stocks good or bad. It makes them bets on execution. The rise of long-term investing, a new idea, emerges for centuries. Stocks were traded like commodities. Buy, sell, speculate. But in the mid-20th century, something changed. Economists started studying markets statistically. They discovered a shocking pattern. Over long periods, diversified stock markets tended to rise, despite crashes. Not smoothly, not predictably, but persistently. This led to a radical idea. What if the best strategy isn't trading, but owning? The birth of buy and hold instead of guessing short-term price movements. Investors could buy broad ownership, hold through volatility, let economic growth do the work. This approach wasn't exciting. It wasn't flashy, but it was powerful. Over decades, compounding took over. Small gains stacked. Reinvested dividends multiplied. Time did the heavy lifting, and for the first time, ordinary people could realistically build wealth. But there was a catch. Compounding, the force everyone underestimates. Albert Einstein allegedly called compound interest the most powerful force in the universe. Whether he said it or not, the math is undeniable. Compounding means your gains start generating gains, which generate more gains, which accelerate over time. In the early years, he'd feel slow, almost pointless. But later, it becomes explosive. This creates a psychological problem. Humans are terrible at waiting. Why most people quit before compounding works? Compounding rewards patience, consistency, emotional control. The market, however, constantly tempts you to chase hot stocks, panic during downturns, compare yourself to others. Most investors don't fail because they chose bad investments. They fail because they interrupt compounding. They sell too early. They jump strategies. They react emotionally. The tragedy is this: many people invest for decades, but never allow time to do its job. The invisible enemy, psychology, beats math. If markets were purely mathematical, everyone would succeed. But markets are human systems. They amplify fear, greed, overconfidence, regret. Behavioral finance studies show something disturbing. The average investor earns significantly less than the market itself. Not because the market is rigged, but because human behavior is self-sabotage. The cycle of emotional investing, it usually looks like this. 1. Market rises. Confidence grows 2. Media coverage increases 3. Friends brag about gains 4. Fear of missing out kicks in 5. People buy near the top 6. Market corrects 7. Panic sets in 8. People sell near the bottom, then they swear, "I'll never invest again." Until the cycle repeats. The market transfers money from the impatient to the disciplined, not overnight, but inevitably. Risk. The word everyone misunderstands. Beginners often think risk means the chance of losing money. That's incomplete. Real risk is being forced to sell at the wrong time, not meeting future obligations, outliving your savings, or abandoning a strategy when it matters most. Volatility is not risk. Volatility is the price of admission. Trying to eliminate volatility usually increases real risk. This is one of the most counterintuitive truths in investing. Diversification. Why concentration feels smart until it isn't putting all your money into one stock. Feels bold. Sometimes it works. Often it doesn't. Diversification exists because no one can predict the future. Reliably, even great companies fail. Entire industries disappear. Diversification isn't about maximizing returns. It's about survival. You don't need to be right every time. You need to avoid being catastrophically wrong once. Modern markets, same psychology. Faster speed technology didn't change human behavior. It accelerated it. Now, news spreads instantly. Trades happen in seconds. Emotions travel globally. Apps make investing feel like a game. Notifications trigger dopamine. Social proof replaces research. The market didn't become more irrational. It became more efficient at exposing irrationality. The paradox of knowledge. Why more information doesn't help beginners assume, if I just learn more, I'll outperform. But studies show, more trading leads to worse results. More predictions lead to more mistakes. More confidence leads to higher losses. Knowledge matters, but restraint matters more. Understanding what not to do is often more valuable than knowing what to do. Transition. The pressure point ahead so far. We've learned stocks represent ownership, not certainty, compounding rewards. Patience, not brilliance. Psychology is the real battlefield. Most failures are behavioral, not analytical, but there's still one major piece missing. What happens when the entire system is stressed at once? When fear spreads faster than logic? When liquidity vanishes? When even disciplined investors are tested? To understand that, we need to revisit major market collapses, systemic risk, and why this time is never different. That's where part 3 begins. Cliffhanger, the question that matters most if long-term investing works, if markets recover, if history favors patience. Why do so many people still get wiped out? The answer lies in moments when the system itself bends, and sometimes breaks. Conclusion: the quiet truth about the stock market. So after centuries of booms, busts, bubbles, and recoveries, here's the truth most beginners never hear. The stock market is not a shortcut. It's not a game. And it's not a guarantee. It is a system built on time, belief, discipline, and human behavior. Those who misunderstand it chase excitement and pay for it with losses. Those who respect it accept boredom and are rewarded with compounding. History shows us the same lesson again and again. Markets don't fail people. People fail themselves under pressure. 3 takeaways to remember. 1. Stocks are ownership, not predictions. You're buying a piece of a real business, not a promise of quick profit. 2. Time beats timing. Compounding works slowly, then suddenly interrupt it, and you break the system. 3. Your behavior matters more than your intelligence, fear, and greed. Destroy more wealth than bad analyses ever could. A final warning, every generation believes this time is different. Every generation is eventually proven wrong. The patterns repeat because human psychology doesn't change, only the technology does. And the market doesn't care who you are, how smart you feel, or how confident the crowd sounds. It only rewards those who stay disciplined when it's hardest. Call to action if you want to understand the stock market. Don't just learn what to buy. Learn how the system works, why it breaks, and how to control yourself when it does. If this video helped you see the market differently, like, subscribe, and stay curious, because the real edge isn't secret information. It's understanding the story you're stepping into.